In this video we will be exploring a large trade in the 4-hour timeframe of the Australian dollar. This is one of the most common types of trade situations that occur in the market, and you can observe it since the 1 minute up to the monthly chart. As I have been saying repeatedly in my videos, the timeframe you pay attention to is irrelevant. The setups and techniques can be equally applied in all of them. The highlight of this video will be the introduction to how the hidden symmetries of price can be unveiled by tools like the pitchfork for maximum precision and the optimization of the well-known healthy risk-reward ratios. Trading with ratios that are at least 1 to 3 is an absolute requirement, as the fractal flow students already understand, but if you are able to see opportunities that yield more than that, you will experience even less psychological pressure in your trades. The subjective perception of risk and your precision as a trader is an obvious trade-off. The more precise you become, the less you will have to worry about risk. If you take a look at the chart, you will be able to notice that the price action between numbers 1 and 4 produce what I usually call a solid market structure in high number 3. That's because sellers were able to prove themselves against the buyers when they surpassed the low number 2. This can be analyzed from different angles. For example, in a downtrend the sellers are able to accumulate more energy than the buyers. By deduction, they are also capable of expending more energy. This is the reason we see large downward movements and short upward movements in a downtrend. This idea relates to the conservation law in physics, where nothing is created, and everything is transformed. This is a useful idea because we can make certain projections about the future of price based on how the buyers and sellers are accumulating and expending their energy. As you are probably aware by now, when we have the formation of a solid market structure, we also end up having a supply and demand zone, which is a rough estimation of the turning point inside the solid market structure. In other words, a supply and demand zone is an area in the chart that represents the moment where the control of the market shifts from the buyers to the sellers or vice versa. As you can see in the supply and demand zone I drew coming out of solid market structure number 3, somewhere within that little zone the sellers decided to take control to create low number 4. The great thing about these zones is that they make perfect sense under the light of market logic, and they provide us with a trade opportunity that contains the perfect risk framework. That's because a supply and demand zone will always occur near a solid market structure, so the trade opportunity will always have a built-in logical stop loss, which is protected by the solid structure itself. This is one of the ways in which we can trigger trades using tight stops and long targets, which is our main goal to begin with. That's all very good and logical, but we need to be careful because identifying a supply and demand zone is not enough to open a high-quality trade opportunity. Let's sum up what we have so far in this chart for a moment so we can move forward in the analysis. We have a market starting to create lower highs and lower lows, and as a consequence, we have the creation of solid market structures on the way down that could end up signaling short trade ideas. There are more contextual details that we can grab in this chart. One of them is the fact that the upward movement that apparently finished with candle number 1 is very interesting momentum-wise. This upward movement apparently ends in a simple reversal divergence that can be observed in the relative strength index. Another thing that we can see here is that the origin of the major market vector that ended in candle number 1 is far away from where price is right now. In other words, the upward movement not only appears to have ended, but there is a lot of headroom for this market to travel to the downside. This is an important consideration we have to make when we deal with risk-reward ratios that are 1 to 3 or higher. The market must have headroom to travel in the desired direction. Moving on the analysis, we can see that in number 5 price indeed comes back to the supply and demand zone we have been talking about in the video. Since not everything in the market is easy and fun, we have to deal with the upward volatility of that candle that comes back up and creates high number 5. When traders see a candle like that, they tend to give less weight to the downward context we have so far, and that's the mistake that we try to avoid in here. It's really important that you remember that one piece of evidence is not enough to create or destroy a market context. We have to take many elements into consideration, otherwise we will be ambushing ourselves with all sorts of illusions that are waiting to catch us in the market. Observe also that right after candle number 5, price starts to go back down. In other words, after entering the supply and demand zone, price starts to show weakness to the upside, which is something that agrees with our general picture in here. If we are indeed looking for a short trade in this market, this is the point where we must start looking for smart ways to enter. There are thousands of ways to enter a short trade like this, but the simple one is to wait for price to reach an area like a supply and demand zone, and then observe what it does when it is in there. If it gives some signs of hesitation, you can decide to risk your capital. At this point we can draw the main pitchfork considering the vectors between numbers 3 and 5. Notice how the downward outer line of the pitchfork is pointing to a market edge that functions as a second entry in case you missed the moment where price entered the supply and demand zone. One interesting thing to observe in here is the tail frequency that is exposed in the lower and outer line of the pitchfork that cuts through low number 4. Observe how those lower tails seem to interact with the fork line. There are two choices here when it comes to the stop-loss order. You can place the stop above high number 5, which would be a high-risk approach, or you can place it above the solid market structure that gave birth to this trade in the first place. That would be a more conservative and more logical approach. The entry of this trade happened the first time price touched the outer line of the fork after number 5 as it is highlighted by the green arrow. Observe that this fork uses only market extremes that are relevant to the trade we are in. The target of this trade will follow a few different advanced principles in technical analysis and risk management. They are what I call the reverse engineering of market contexts, the idea of frequency shifting, and the use of the pitchfork and its auxiliary lines as a foundation to the previous two principles I mentioned. Price sometimes tends to drift away from forks, and that gives us the ability to use Newton's laws of motion to predict where price is going to reverse. Notice that right after high number 5, price drifts away from the fork and then comes back in the overthrowing motion. That creates a shift in frequency that can be extrapolated in the future. Notice also that we have a fourth line down with this pitchfork, which is equidistant to the main 3. The line that will represent the dynamic target is the line that is tested at least once, and it follows the underthrowing and overthrowing nature of how auxiliary lines of the pitchfork move. This is the most complicated subject in all technical analysis, and that's why I'm creating a whole course to explain it. It's quite difficult to come up with a complete explanation that makes justice to the concept in just a few minutes. The initial target of the trade will be somewhere within the third and fourth lines of the pitchfork we have here, but it will be fine-tuned depending on what price does when it gets there, just like we do in the entry portion of the trade. Let's see how the market responds, and then I will make further comments about the whole situation. As you can see here, there are two green arrows pointing up at the bottom of the chart. The first one represents that first touch to the underthrowing action that was predicted when price was near number 5. The second green arrow was where the trade was closed based on the confirmation touch given by the previous green arrow. It's not difficult to see that pitchforks are a precision tool with this example. If you enjoyed this video, please support the channel by clicking the like button, subscribing to the channel, and leaving your feedback below. If you are interested in learning advanced trading techniques, please check out the strategy store in the link available in the video description. You can also find more than 120 free videos in the channel with high-quality analyses of the market using the techniques. I hope you found good value in the material I produce. Thank you for watching and have a great weekend.